Hello to everyone. Today I am here with Financial Statement Analysis Part 5. If you are interested to have update videos on banking and finance related topics, please do subscribe my channel. In the previous lectures, we have covered liquidity ratio and activity ratio. Today we are going to discuss the leverage ratio. Leverage ratio tells us to what extent a company using its debt to pay from its operation and how easily it can cover the cost of the debt. Here we have two questions. First of all, ability to meet the financial obligations from the income a company generates from its operations and how a company can cover the cost of the debt. It means if you are paying interest rate equal to 16% and if your return on your asset or your return profitability is less than the cost of the debt, it means your company can come in problem anytime. What do you mean by the leverage? You should have clarity about it. Leverage is the load that company bears in the shape of the debt. Sometimes we say a company is a zero leverage company. It means company is totally based on the equity. Company didn't have any type of the borrowings. Second thing comes, company is a low leverage company. If a 20% part of capital employed is related to capital debt and the 80% is owned by the owner, it means it's a low leverage company. If the case is vice versa, 80% is the debt part and 20% is the equity part, we can say that the company is high leverage. But the question arises, either leverage is good or bad. It depends how you utilize your debt. If you are utilizing the debt for revenue generating asset like machinery, equipment, definitely that revenue generating equipment asset will generate the revenue, generate the incremental cash flow and able to meet its burden itself. If you have utilized your debt for the luxury, like luxury vehicles, luxury setup, so it can become problem for the organization. First of all, debt to total asset ratio measure a company's ability to serve its debt obligations with respect to its tangible and intangible assets. That is equal to total liability minus current liability divided by total assets. Debt to fixed asset ratio measures a company's ability to serve its debt obligation with respect to its tangible assets. Now here, total liability minus current liabilities is to fixed asset. It gives us the position of debt to fixed asset. Thereafter, we have debt to revenue generating asset. It's very important. Usually, we do not consider as a part of our analysis. Measure a company's ability to serve its debt obligation with respect to its tangible revenue generating asset. Total liability minus current liability divided by revenue generating fixed asset. You can add building and the land as a part of revenue generating because these assets are also the supporting assets for particularly the production area. Thereafter, total debt to total equity, it gives us the portion how much part is related to the debt and how much part is related to the equity. Measure the company ability to serve its debt obligation with respect to shareholders' equity. Total debt to capital ratio. Measure the company ability to serve its debt obligation with respect to capital, including shareholders' equity and interest-bearing debt. Now, here, on one side you have capital equity, on the other side you have debt equity. Interest bearing means all the types of the debt on which you are paying certain markup or the interest. So this ratio is equal to total long-term debt divided by total capital employed, that is equal to total equity plus total long-term debt. Because short-term debt is met against the short-term asset. And that is a part of current ratio. First of all, debt to total asset, it's gradually increasing from 5.69% to 14.09%. Total debt to fixed asset, it's also increased from 12.85 to 31.65%. Debt to equity, it's 0.62 to 11.17. Debt to capital ratio, 0.61 to 10.05%. So there are the increasing trends. Here again, one more question arises, that is good or bad. As I earlier discussed with you, if you are utilizing the debt properly for the revenue generating asset, it's always good. On the other side, if the company is very well performing, even other assets may not matter, because debt provides you tax leverage as well. We can conclude our discussion. Debt can be good if it's properly managed or properly utilized. Thank you very much. See you again on the upcoming topic related to financial statement analysis very soon.